The U.S. national debt has grown from $19.6 trillion in 2016 to over $39 trillion today, a staggering increase that has sparked concern among investors and economists. This rapid expansion has raised questions about the long-term stability of the global financial system. Treasury borrowing has accelerated, with structural deficits embedded in current fiscal frameworks. The rate of debt accumulation is estimated at around $221 million per hour, a figure that reflects persistent fiscal pressures regardless of changing administrations or economic conditions. The debt growth has occurred across different economic cycles, including periods of strong labor markets and economic growth. This suggests that current fiscal structures rely heavily on continuous Treasury borrowing. Historically, stronger economic conditions would reduce deficit pressure by increasing government revenues, but this has not been the case recently. In fact, borrowing has continued to rise despite these favorable conditions. Pandemic-era stimulus programs played a major role in accelerating federal borrowing between 2020 and 2022. Emergency fiscal measures expanded Treasury issuance as part of broader recovery efforts. These programs significantly increased government. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Spending and borrowing obligations. The result has been a continued rise in national debt even after the initial crisis passed. Investors are closely watching how rising debt affects inflation and the long-term confidence in the U.S. dollar. The increasing interest costs associated with this debt add to the fiscal pressure. As the Treasury continues to issue more debt to fund ongoing obligations, the question of fiscal sustainability remains a key concern. Rising debt levels could impact monetary conditions and investor sentiment globally. The structural nature of the deficit suggests that the current trajectory is unlikely to change soon. This is due to embedded spending commitments and ongoing economic conditions that support continued borrowing. The debt growth is not a one-time event, but a persistent trend that has developed over multiple economic cycles. Analysts are now focusing on how this debt will be managed in the coming years. The Treasury's ability to issue and refinance debt at favorable rates will be a critical factor. If interest rates rise significantly, the cost of servicing the debt could become a major burden. This could lead to difficult fiscal decisions in the future. The global financial system is also watching closely. As the U.S. dollar remains a dominant reserve currency, concerns about the sustainability of U.S. debt could affect confidence in the broader financial system. If investors lose confidence in the dollar, it could have ripple effects across global markets. The next signal to watch is how Treasury issuance and interest costs evolve in the coming months. If debt growth continues at the current pace, most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. It could signal deeper structural issues in the U.S. fiscal framework. Investors and analysts will be monitoring developments in Treasury borrowing and fiscal policy closely. The stakes are high, as the mechanisms of debt accumulation and interest cost management will determine the future trajectory of the U.S. economy. The next key indicator will be how the Treasury navigates the challenges of refinancing and maintaining confidence in the dollar. The global financial system is closely watching these developments, as they could have significant implications for markets and investor sentiment.